Hey Kanish, how you doing?
Hi, Owen. How are you?
I'm really good because it's great to have you back on the show, mate. It's really exciting me to be sitting here because we've done this many times before, you and I know the RAS community really loves having you on the show and just to share some of your knowledge and your insights around ETFs in particular, but also just building multi-asset portfolios and all of the things that come with predominantly, passive income and long-term sustainable growth from investing. But fill us in on what you've been working on lately, because it's been a little while since we've had you on the show. So for folks that are long-time listeners, they'll be familiar, but even some of the newer listeners may not. So what have you been up to?
Yeah, I think I was looking back. It's been about 18 months since you and I last did an episode, and a little bit has changed in some respects in that I've joined PIMCO recently, and a lot of people don't know who PIMCO are. And I remember when I joined PIMCO, telling my family and friends, and they were like, PIMCO, who are they? And it's interesting because if you're in financial services or investment management within the industry, you definitely know who PIMCO are. They're one of the largest asset managers in the world. They manage nearly 3 trillion Australian dollars for clients' money. And that sort of puts it into perspective. But for me, I joined as head of ETF sales. So I've joined to help lead and launch their ETF products. And it was great to be part of a bit of history, to bring PIMCO's ETFs into Australia. And we've launched 4 products just recently across the fixed income range, and that looks at Australian bonds, global bonds, diversified fixed interest, and global credit. And these 4 really, for me to come out and help, be part of a bit of innovation and a bit of history, it was quite special, and I was quite fortunate to have this opportunity.
Yeah, for sure. It's I know as I look around here and spoken to the team recently, it's been really good to see, and I think the timing has been excellent. I think that's a big thing, which we'll talk about in terms of fixed income, bonds, just in the ability for people to build proper, like professional multi-asset portfolios, whether they're in retirement or they're accumulating assets. It's now better than ever, and these 4 ETFs, which we'll allude to a little bit throughout the show, I think is going to signal some things. So, Kanish, you mentioned that PIMCO's, a brand that's really well established if your household has financial services people in them, but if your household does not have a financial services professional in there, PIMCO may be a relatively new name insofar as ETF investors here in Australia. I'm hoping we can kind of fill people in on this because PIMCO globally is a massive brand, really well established. So can you give us a sense of the scale and scope of the ETFs themselves?
It's very interesting that you asked that question. PIMCO is an innovator in the ETF space. We launched our first the first active fixed income ETF in 2008, 2009 in the US. And from there, what PIMCO has tried to do really is be really innovative, and a lot of the strategies that we have globally are looking at using active strategy and active fixed income capabilities and bringing them out to investors. So when you think about the size and scale of PIMCO's ETF capabilities, we manage close to 40 billion US. So put it in Aussie dollar terms, it's about 75 in sort of an Australian dollar term across 40 products in the US and Europe mainly. And it was, you talk about timing. It's really hard to time these things, and this hasn't been timed from a specific macro perspective. From where we've stood in terms of developing these ETFs that we've launched for the Australian investors, it's taken many months, a lot of tireless hours from many individuals across the globe, and it's been really great to see this come to fruition and start to bring institutional grade capabilities to all Australian investors. And if I take actually a step back from what I've just talked about in terms of PIMCO's ETF presence, we're sort of well versed in that space, but a lot of Australian investors won't have heard of PIMCO. And we talked about that just briefly, and I mentioned when I started at PIMCO, I went to my family, went to my friends, and said, "Oh, I'm really excited. I'm going to be helping launch ETFs for PIMCO," and they sort of gave me this quizzical look. Some of them were like, "Who's PIMCO?" And to be fair, a lot of these family and friends aren't in financial services, so I respect that. But actually, what Australian investors may not realize is PIMCO's been around for over 50 years. from where we stand, we talked about that $3 trillion dollar number. So we managed close to $3 trillion across the globe, across strategies for a lot of different investors, across institutional investors. So when you think about institutional investors, we're thinking about super funds, we're thinking about insurers, we're thinking a whole range of various institutional type of clients. And so when I think about that, I'd actually say a lot of Australian investors probably have exposure to some form of PIMCO product or strategy. They just don't know it because it's being utilized within their super fund. And across the advice space here in Australia, so PIMCO, again, globally, 50 years of history, but we've been around for nearly 25 years in Australia. With strategies that are run out of Australia. So we have a team here, and obviously, we're sitting in our office here in Sydney. But again, I think people may not realize a lot of advisors know of PIMCO, and a lot of financial advisors and investment professionals use a PIMCO strategy or have historically. And I think for where I stood, and is what's been interesting in my journey in the ETF space, I think we talked about it briefly, but I was speaking to my wife the other day, and I've had, some input or exposure in launching about 10% of Australia's ETF market at the moment, which I sort of took a step back into. I think that's really cool because basically building products that hopefully my kids will use in due course, but when they're older and they're on their investing journey. But what I found interesting was from a ETF perspective, fixed income in that sector, it lacked something. And, it lacked an element of institutional grade capability. And if we can bring to all Australian investors an element of that institutional grade strategy, package it up into an ETF that they know how to invest in, well, I think that's the goal, isn't it? It's trying to just broaden out this market.
You mentioned the role of professional investing in the hands of all investors, right? And I think that's a big part of what we're going to see over the next 5 to 10 years in the ETF space here in Australia is end investors and financial advisors who are managing portfolios on behalf of their clients to have access to the best products or the best funds, I should say, rather than having it, what we call an unlisted managed fund or something like that. Having all that capability in one place is a big asset. And I know we're going to talk about this, so I just wanted to get you to clarify this point for us. When we mention active ETFs, can you explain what we mean by an active ETF?
Yeah, this might be controversial, but I think the whole concept of passive and active ETFs, we're well past that. And the reason why we still talk about this sort of, which team are you on potentially? Are you active or are you passive from an ETF standpoint? Is because when ETFs were first launched, over 30 years ago in Canada, in the US, in North America, they were launched as passive strategies. And that's the incubation of this industry has been from a passive perspective. But when you take a step back, ETFs are just a vehicle. I sometimes use this definition. ETF stands for exchange traded funds. Flip that in reverse. It's a fund that is traded on exchange. So that's all that it is. It's a vehicle for an investor to access a strategy. Yes, most of the Australian ETF market and the nexus and the start of the global ETF markets were in passive. But what we're actually seeing on a global scale is more active strategies being launched in an ETF vehicle. And as a result, we're actually seeing greater adoption by investors because they now have choice. They have choice beyond the passive vehicles. And in certain asset classes, I would argue passive underperforms active. And I can say that actually coming from my experience, having worked in very large active firms like BlackRock and Fidelity, and passive firms like Global X. You don't shy away from that because it's good experience to have, because I can talk through and say, well, for clients and for their best interests in certain areas of your portfolio, yes, passive makes absolute sense. But in other areas of your portfolio, that may not ring true. Just because it works in large cap equities doesn't mean that it will work in fixed income, for example. And so that's where I think we need to sort of take that step back. Essentially, within an ETF scale, all we're trying to do from from PIMCO perspective and what other active managers are looking to do here in Australia is bring forward their strategies that they may have had in a managed fund form and bring them out into a listed vehicle, an ETF vehicle, that essentially opens that strategy up to every investor in Australia. Where previously there'd be some barriers. You could still access, our managed funds, which we run and we will continue to run. But it would either potentially the minimums are a lot higher than they would be for an ETF. And also they may have to be accessed via a financial planner as well.
So it democratizes that access point. And it doesn't matter if it's passive, active.
It 100% shouldn't matter. So I'd actually put forward this thought here is that they are ETFs. ETFs are a vehicle. Look at them that way and make your decision based on the strategy versus, active or passive. Look at the underlying strategy and really do that due diligence and that study and what works best for you. And obviously speak to an investment professional as well in that respect.
Yep. We're going to talk a little bit about, or hopefully a bit more about fixed income. This is really interesting for me in a few reasons, which I'll get to in a little while, but I'm an investor myself. So I like to see what's coming out and put these things in portfolios, right? So can you just I know this is kind of foundational for people, but just explain what we mean by fixed income when we talk about either the market or the types of investments or the roles, however you want to frame it. What do we mean when we say fixed income?
Yeah, to break it down really simply, a fixed income is a bond or an investment security that essentially is like a loan with sort of an additional caveats to that. What generally it is when a institution, whether that be a corporate or a government, wants to raise money, they will issue bonds and investors can take access to those bonds. Now, these bonds will be for a certain amount. So let's call it $1,000. Now, this $1,000 bond generally has a fixed maturity date. And that maturity date could be 1 year, 3 years, 5 years, 10 years, whatever it may be. So there's a set point in which that money will be returned to the lender, essentially. Now, from this respect, then it has coupons. So basically a payment. And that could be attached to a fixed rate. So it could be, it's going to be 2% per year. And that will then, every year for that life of that bond, we'll be paying at 2%. Now, this particular coupon, actually, it was what's interesting. Why do we call that coupon? We call it coupon because when bonds, originated, over 100 years ago, it was a piece of paper. And it was basically a piece of paper with literally coupons that bondholders would go and rip off to go present to receive their payment.
Oh, is that where it comes
That's
from?
where it comes from. And so because now we've moved into sort of electronic trading of sort of bonds, the idea of a coupon and literally ripping that off and doing that doesn't exist anymore.
Okay.
But, it still has stuck.
So you go get your coupon payment.
Exactly right.
Okay,
Yes.
yeah. Is that what you were carrying in the office before?
Yeah, so I actually had it here. So
for anyone that's watching, you can see this.
I wanted
holding it up.
to show you. So that literally is the coupons that people would rip off.
Yeah, wow.
To go to get that coupon payment basically.
Huh.
So I found that really interesting from my perspective because to just break that down. And I think the key concept here in terms of the risk return and when we think about I guess what is the different types of issuers from bonds. Talked about it could be a government, it could be a corporate, it could be a municipal. So from that perspective, that riskiness comes from the issuer perspective, and that's where we sometimes see those credit ratings as well. With bonds, obviously, we have fixed, we have floating, and the price of bonds is very much impacted by the price of rates and what happens there. So essentially, it's sort of an inverse.
Yep. Okay. So if interest rates go up, bonds go down. Is that right?
Yes, exactly right. So let's put an example of start of 2022. I've got a bond that is currently paying 3%. Now, that is great. That's what my exposure is, and it's a fixed rate. But all of a sudden, we were in that scenario where rates started to go up and quite aggressively. Now, if rates have gone up past the point of what my bond is paying, what happens? That particular bond's price is going to come down because as an investor, because bonds can be traded on that secondary market. So when they're issued, that holder of that bond can go, okay, well, I actually want to trade this and I want to go sell it to someone else. I want to go buy another bond on that secondary market in the same way you do a share. But what I will say is the secondary market of bonds and the secondary market of shares is two very different things. It is very hard to trade bonds for an average, everyday investor in that bond market because the minimums are extremely high and the liquidity is not as great as you would have for an equity market. But in that sort of basically example, that particular bond that was paying 3%, interest rates have gone up. The particular bondholder is sitting on something that's paying less than what someone else could go and get from a new bond that potentially is being issued at a higher interest rate, or they could go to a term deposit and get a higher rate as well. So therefore, the bond price comes down. But then the inverse happens. We're in an environment now where we had a period of high rates, and we're now in an environment where things have started to stabilize from an economic perspective, from an inflation perspective. And so we actually are seeing rates come down. We saw the RBA obviously cut rates for the first time in many years. And so we're starting to see this point of, well, will we start to see bond prices be positively impacted in the current rate environment that we're going to foresee for this next sort of 18, 24, 36 months.
Yep. It's really interesting because a lot of people do write into me and they say, well, hey, Owen, you talk about fixed income, you talk about bonds and these types of things. But they look in Google or they look in the share price charts and they go, the bond ETF, it doesn't look very good. And that's the explanation that people miss if they don't have the true understanding of exactly what's happening with the mechanics of the industry.
Yeah, and it also comes down to what's the implementation tool of a bond or of a fixed income portfolio or fund, ETF, whatever it may be. It's to also be and stabilize against the volatility that exists. Equity markets have an inherent sense of volatility. That inherent sense of volatility is for a multitude of factors, and we have seen that especially, I think, from a PIMCO's perspective, PIMCO runs these quarterly forums where we get we've got about 270 portfolio managers around the world across all of our strategies. We get them all into a room effectively. We have over 80 credit analysts and we get all these people into a room. We get our global advisory board, which includes people like Joshua Bolton, former chief of staff in the White House. We've had Ben Bernanke on that. We've got Gordon Brown, former Prime Minister for Britain, and they come into a room and they talk about what's going to happen in the world and from a macro perspective. And it's interesting because we look at equity markets and they come out of each of these quarterly forums with a theme. And the latest forum that they held in December, January, the theme was uncertainty is certain. And I think that's really apt because I'm looking at equity markets, I'm looking at Meta's gone up 25 days in a row, whatever it was, hit a record of going up. I think you put up that post. I think I did see that, so I appreciate that. And it's like, okay, at one point does that change? There's potential policy uncertainty in the US, with the Trump, with President Trump there. But within fixed income, there's some element of stability that you're trying to talk to investors about, which is why generally when people look at fixed income in their portfolio, it's normally in that defensive allocation. It isn't, primarily used within the growth allocations, or public fixed income anyway, because it's generally paying an income with that coupon payment that we talked about. With bondholders, they receive that coupon payment, but it's also this element of diversification. So you've got, potential stability or, basically diversification to bring down volatility within the portfolio against equities, some capital preservation within that. Also, you're hedging out some of the potential inflation risks that exist as well.
You mentioned before this idea that it's not just, active versus passive, which I really do appreciate because I firmly believe that. I think as investors mature and they build better portfolios, they'll realize that there are many different markets, many different investment types and strategies that can be pursued at different times or in their core portfolios for a long period of time. I think there's a kind of a myth that we should debunk, which is that we have these reports in industry where it says effectively that, there's all these like passive vehicles, so these, predominantly index funds that outperform the active fund managers, and that seems to ring true for some markets. But when it comes to fixed income, I think there's a very important distinction that should be made here. So can you clarify how those kind of findings relate to fixed income investing?
Yeah, so it's very important when we look at that active versus passive debate. I mentioned it before, within certain asset classes, there is an argument that passive managers and passive indexes have outperformed their active manager peers. And that's okay, that's absolutely fine. But when I take away the equity lens of that and I apply it to fixed income as an asset class, we're actually seeing on average, and we've done some analysis over 10 years to the end of December of 2024, that about 85% of active managers are outperforming their passive benchmarks that they're tracking against. Now, I can tell you, as we sit here, to the end of January, that the 4 strategies that we've launched in an ETF vehicle, all of them, when I looked at over 1 year, 3 years, and 5 years, were all outperforming the benchmark that we use to benchmark ourselves for each of those strategies. Now, that's net of fees as well. And why is that? Well, within the fixed income world, we talk about equities. So I talked about, what is a bond. Now, if I wanted to go out and recreate the S&P 500 index, that's a very it's hard, it's 500 stocks, but it could be done if someone had the funds to do that. They'd go out and buy those 500, and then they can buy and sell as they needed to as that index rebalanced, and there's liquidity to buy and sell.
So if they had enough money, they could go and buy all 500 stocks.
Exactly. Yeah. And if they had the time and had the patience to do that, so be it. And so within the bond world, if I look at the Bloomberg US Ag Index, which is sort of one of the premier fixed income indexes from a US perspective anyway, there's over 10,000 names within that index. It's okay. Now, again, say someone had the funds to do that. You go out and you buy all those 10,000 names. That sounds reasonable. But then what happens when 20% of that index at the end of that year, remember we talked about how bonds mature, they have sort of finite endpoints where the money is returned to the bondholder. Well, normally we're seeing about 15 to 20% of that index, the bonds within that index, they actually mature. So what do you do then? You've got all this cash, you've got to go out and now buy new bonds. By the way, that's really hard to do. Normally to buy bonds within that secondary market, you have to be a wholesale investor. The minimum parcel sizes are hundreds of thousands of dollars. So it's just very difficult. Then if you need to sell any of those, it's not like the equity market. I can just jump on, my whatever trading platform I use or speak to my broker or advisor and try to sell my share. And I've got liquidity on the other side, and that's great. No, it doesn't work like that in the bond universe.
Right.
And so what we've generally seen from an active perspective is, from where PIMCO sits, there are inefficiencies that are created within this universe. And from an index perspective as well, you think about bond indexes. So one, it's really hard to replicate. But two, the structure of general passive fixed income indexes is actually inefficient. And I say that because what you've generally seen is you look at, say, the bond indexes that most large passive fixed income ETFs track. They do it on a market cap basis. So what does that mean? In the same way in S&P 500's market cap, it's done based on the largest company is the largest weight, and then so on and so forth, it goes down. That's how traditional passive fixed income indexes have been created as well. So what you're essentially telling me is I'm giving more money to the largest debt holder, which
sounds risky.
Sounds risky. And then so if I put it into sort of general terms, if me and 10 of my friends went to a bank and said, we want to borrow money, would the bank go to the person that had the most debt? Oh, here's the loan. No, they would probably do their due diligence. And that's what effectively we do as an active manager is we do that due diligence. We're looking across different fixed income markets around the world. We're looking at governments, corporates. We're looking across different industries within the corporates. We're going down to a level of detail that most other managers aren't. And that's what we're doing as an active manager to identify opportunities and inefficiencies within that bond market that a passive index can't do, because they're effectively just tracking something. And so I've come from a world of both active and passive. I don't have, and for each investor, they've got to make their own decision. But I do firmly believe when I'm looking at fixed income strategies of where I sit, there is a definite benefit of active management over the passive world. And so don't take that same lens that you might take from an equity side into your fixed income part of the portfolio.
I think that was one of the most comprehensive overviews of why you need a different lens. And I really appreciate you doing that, Kanish. I've got to admit, from my perspective, like as someone that is trying to build portfolios for our community and do all that, when I look across the Australian ETF landscape and I look to different fixed income vehicles, when I heard that you guys at PIMCO were launching the 4 ETFs that you've already launched, I was like, that's really interesting for me, because in Australia, a lot of the largest ETFs in fixed income are indeed those ones that you mentioned, the index, and people often talk to me about like, well, why don't you use, just out of the box ETFs that do like a very regimented thing? And because sometimes you need something different, and in some markets you want a different exposure. And right now, as we sit here in early 2025, with rates globally, rates here in Oz trending the way they're trending, I think to myself as an investor, well, I don't want to expose myself to unnecessary risks. I want to get the benefit of falling rates. So I want to allocate capital in a way that is prudent for this market environment. And I guess one of the questions that I had for you is, a lot of our investors that are listening will be thinking about retirement, in retirement, or just generally thinking about passive income. And I'm just curious, like as you sit here today, you've spoken to probably thousands of financial advisors now, who knows, how you see investors typically allocating to fixed income. I know it's a really broad question because every investor is different, but just broadly how you think about the makeup of most portfolios with respect to fixed income.
I think it's definitely underrepresented in Australian investors' portfolios. So if you were to have your portfolio managed by a financial planner, investment professional, or by a super fund, you're going to have exposure to fixed income because they will adopt whether it's a 60-40 or whatever it may be, but they will have an allocation to fixed income within your portfolio in some way, shape, or form. If you go down the path of investing in a multi-asset strategy, whether it's through a fund or an ETF, of which some have become quite popular, again, they also use fixed income within their portfolios, because from where we look at portfolio construction, we've found it quite, it's well researched and proven that element of diversification between equities and fixed income provides a stable return over the risk that you're trying to generate in terms of trying to achieve something, 15, 20% outperformance from an equity portfolio. There's an element of higher risk that you're going to attribute to that portfolio accordingly. So what I would say is, I think we're underrepresented as an Australian investor. And I actually listened back to a few of episodes that you've done with various individuals across the industry. I've listened to a number of other podcasts and just started when I was, doing a bit of research. And I found when people were asked, oh, well, I do want to invest in fixed income, but when I start my investment journey, I buy equity ETFs or I buy equities, and that's generally how I start. And that's understandable, because even when we talk about fixed income, it can feel a little bit scary to understand. There's an element that you've got to take a little bit of a step back. When you break it down very simply, it makes sense, but we've probably, as a finance industry, we probably haven't done a good job at educating the market around what is a bond and how to look at fixed income. What I generally would say is, within that portfolio from a retiree perspective, obviously they may have a higher allocation to fixed income. And then within fixed income, there are various different types of strategies that they can look at. They can look at a diversified portfolio of non-government, high quality in fixed interest securities, and that's looking at global credit strategies, for example. They could look at a diversified strategy which incorporates Australia and global. They could look at just specific areas, whether it be just global or just Australia. And in the ETF world, there are many more now that are starting to come to market, and that's what I think is beneficial now. Whereas previously there wasn't choice in this space, there is now greater choice for investors. So from a retiree's perspective, I'd be looking. I can't say specifically, but I'd say you probably need to reallocate to fixed income right now. And what's been really interesting, it's on our website. There's an article there which is the Magnificent 7 Reasons to Include Core Bonds. And these are some of the reasons to consider, why you should look at core bonds and why now as well. So we're looking at uncertainty is certain. So I spoke about that theme from our cyclical forum that we ran in December, January, which off the back of that, we looked at where markets are and what the macro environment is looking like. And PIMCO has a very strong ethos in how we look at that macro and that macro outlook, and that sort of takes that top-down approach. And from there, that's how portfolios are really managed, or that insight from that macro outlook. So that uncertainty is really that's certain in what we're seeing. We're looking at the fact that inflation across developed markets, it's normalizing. We've seen that in Australia, and that's one of the reasons why we're starting to see the Fed, the Federal Reserve over in the US last year start to cut rates. We've started to see the RBA here in Australia cut rates. It's because there is that normalization. And obviously, number 3, the third reason is, cash rates are falling. You look at equities. Well, we talked about the fact that Meta's on that, I don't know where has it still continued?
I don't know. At the top of my head, I haven't checked today.
I have no idea. Yeah. But, there's equities are expensive. When we look at sort of valuation metrics, equities are looking expensive at the moment. We look at the fact that we're seeing more defaults and more restructuring. I pick up the AFR every day and I'm seeing some article, in some way, shape or form about some form of debt or, default occurring or restructuring occurring within a number of different, managers around the world. We look at hybrids in Australia, which that's the other thing. An Australian investor generally looks at an equity dividend stock, whether it be a bank or whatever it may be, as their income. That inherently has volatility because of it's an equity, or they look at hybrids, and that whole market is also disappearing. So what should investors now do if they're looking for income within their portfolio? And then number 7 is we look at core bond yield, and they're higher than they've ever been pre-pandemic levels. So core bond yields are higher than they've ever been. And so from that perspective, when we're looking out in this current environment with rates falling, we talked about what happens to bond prices and bond yields being as high as they've ever been, in a number of years. It is a really prudent time for all Australian investors to just take that step back and go, okay, am I over allocated to equities? Potentially. Should I start to consider fixed income in my portfolio? And okay, well, what do I do now?
Yeah, I'm glad you brought up that point around the yield, because I think that's probably the thing that people are missing. Is I had a chat last week, actually, when I was here in Sydney. I had a chat, I can't remember who it was, with someone, and they were saying, well, the ASX 200, the Aussie share market has a yield, I think it was a trailing yield around about 3.5%. But some of the fixed income products, or the things that effectively pay that more stabilized security and the coupon payment, as you said before, are above that. So you can actually use the defensive side of a portfolio to get more income than you would by taking risk, like extra levels of risk, which doesn't seem like a prudent way to allocate capital.
100%. And I think that's where we're at now with fixed income investing. Given the rate cycles that we've had over the past 3 years, I can appreciate certain investors have been a bit more cautious. But what I would say is they've been somewhat uncharacteristic in how traditional, in fixed income asset classes, how they perform. And from a rate perspective as well, that sort of behavior of that rate cycles has been a little bit uncharacteristic as well. You don't ever have seen, 2022, that rapid rate rise to counter the inflation that partly was, or primarily was a result of, the COVID and things like that, and how governments responded accordingly. So from all of that perspective, what we're looking at is there are some very core reasons why investors should consider fixed income within their portfolios. And I would argue that right now, in this current environment, you're sitting there with your term deposits. Probably when you go back to try to enter into a TD, it's going to be lower than what you were hoping for. And to your point, that equity dividend is not there, or across equities across the market may not be there and has that inherent volatility. Potentially, it's an opportunity.
Yeah, I remember sitting at the beginning of 2024 thinking, what a wonderful time it was to invest in anything, because property prices were a little bit depressed, share markets were a little bit cold at the time, but bond yields and income from bonds were starting to rise materially then. But now, as we sit here at the beginning of 2025, we've seen equity markets or share markets have kind of ripped higher, so valuations are way up. But the income from fixed income is now looking probably better than it was in 2024. So you have this kind of like tilt that is available for people with portfolios right now, where they can go, well, yeah, okay, I've done really well at that side. I probably need to rebalance anyway. So now we look across at the fixed income side, and that's why at the very top of the show I was like, well, this is probably that's why I was really interested when I learned about PIMCO launching these strategies in the ETF vehicles for people to now consider anyway. We'll put it that way. Like if someone's listening to this and they're thinking, well, you kind of made the case, it sounds pretty strong. You've given me some really good foundational knowledge around how I can think about it. If you could boil that down into a few key things that we want people to remember from this conversation, and when they think about, capital allocation going forward, what would they be?
Yeah, so if I had to break down to three things,
Yep.
It would be yield, risk measure, and I would look at probably manager expertise.
Okay, so those are the three things you would look for when you're thinking about allocating.
Yeah, exactly. So if I look at yield, what am I looking at there? I'm really trying to identify, the income that particular portfolio or strategy is looking to generate and has generated as well. And what we're seeing is a very high correlation of starting bond yields and what that particular portfolio will provide. And so when I look at that, I'm talking about that yield to maturity measurement. And what I can see there, I'm looking at, across our strategies, and they're in excess of, on average between sort of 5%, potentially 6%, depending upon the portfolio. And that's sort of the expected return that we potentially will see from those strategies. And there's a very high correlation from the analysis that we've looked at that returns will come back. Obviously, historical performance is no indicator of future performance. The other side I'd probably consider is those risk measures. So what do I mean by that? So obviously, investors need to be aware of that interest rate risk. Now, we talked about that. When when rates fall, bond prices go up, and the inverse can also occur. And generally how bond experts, measure that, it's through duration. So that's one potential tool that they measure interest rate risk. And the other one is credit risk. So what is that? Credit risk is the risk of a default by the issuer. So what that essentially means is that money that should be returned and the payments that should be made, that potential that may not happen. In the same way, if you took out a bank loan and your credit risk level was very low, well, that's great. If it was very high, well, then you may not pay bank. The bank may charge you a high rate, for example. And therefore, in the same way with bonds, you generally may receive a higher return or a rate, an interest rate payment, a coupon from bondholders that have a higher credit rating. And so ways in which to consider that is that credit rating. And so within strategies, you can actually see this. If you go on to our website, for example, you'll be able to actually see the underlying portfolios and the makeup of those in the sense of these metrics, the level of duration that we have, the credit rating, and that exposure that we have within the portfolio across. And when I talked about the strategies that we've looked to launch, they're all looking at investment grade quality. So we're not looking below that in these particular ETFs that PIMCO have launched. What we wanted to try to bring out, as I said, was sort of best of breed products for Australian investors. And the third one is manager expertise. So we talked about the fact that why active in this passive world of investing that we see at the moment. And we talked about the fact that there is potential inefficiencies in the architecture of fixed income indexes that passive fixed income ETFs track. And therefore, choosing a manager that has a robust process that is experienced in that particular space is really important. When I look at PIMCO, and as I mentioned to you, when I consider, whatever I used to tell people, oh, I've just joined PIMCO and we're looking to launch ETFs. So especially those in the industry took that step back and like, oh, really? Oh, this is actually groundbreaking. And so from that side, I'd say manager expertise, but manager expertise also in how they navigate the world as well. So we talk about finding inefficiencies in market. That's one of the reasons, from a PIMCO perspective, how we look at active management. But we also talk about taking opportunities when they arise. So we have the concept of dry powder. We've got an ability to pivot the portfolio accordingly. So when something were to happen on a macro perspective or a geopolitical perspective, what I find really interesting is how quickly and the ability for PIMCO to pivot in these strategies. And these strategies that we've launched aren't small strategies, by the way. These strategies from an underlying fund perspective, because these are based on existing managed funds that have been operating and offered to Australian investors for many years. Some of them, one particular strategy, our global bond active ETF, it's based on a strategy that at a global level has about $80 billion in management.
Yeah, right.
I think that's bigger than some ETF providers. But so it's really interesting when you take that step back and really truly understand the scale. And what does that give us? That gives us the ability to take advantage of opportunities that other managers don't have. So that'd be the three things. It's sort of that yield, the risk measure, and the manager expertise.
Yeah, I like that. And just to double click on what you said before about duration, when people go and look at the PIMCO website or any bond fund that you look at, higher number means more sensitive.
Exactly.
And that's really important to understand. And also you mentioned things like the credit ratings. People be familiar with that if they've looked at really any of maybe the big Hollywood movies from the GFC. But the more risk, the higher expected yield to compensate for that.
Yeah, exactly right. It's the same way when you think about an equity stock. If you're going down to the smaller companies that you may not have as much information on, there's a potential for a higher rate of return, but there's also a potential for the higher risk of loss. And that's the same way to think about within the bond market. So if you take that sort of analogy.
Yeah, great. I'll put a link in the show notes to all of the funds that we've talked around today and some of the literature as well. I know you did a video recently talking about some of the things that we've spoken about today in a concise way. So I'll put that down there. There is one final question which I wanted to get across to you, which I've asked you in the past, but I figure it's been a few years. We've known each other for many years now, which is a question, as you know, I like to ask all newer people on the show, and it often stumps them, but you've had it once before. So I'm interested to see if there's any updated thoughts on this. But, the question would be, Kanish, if you could go back in time and tell a younger you one thing about money, finance, investing, even business or life, however you want to take it, what would it be?
I would tell myself, don't keep the blinders on.
What do you mean by that?
So I think we sometimes will hear one thing and just believe that that's always true. Or we see it out in the market from an advertising perspective, and we think, okay, that must be true. I think in also our current day and age of TikTok and social media, we need to do our research. So sometimes about taking the blinders off. Yep. And I say that because, a younger me wouldn't have looked at sometimes, managers like, whether it be PIMCO or others, because you may have just seen one particular manager just in front of you for whatever reason. So it's just about taking that step back, knowing that there is more out there and doing that element of research, and also pick up the phone. or an email, whichever works. But don't be afraid to pick up the phone and speak to the issuers as well. So do that research is probably something that I've realized and I've learned over my career.
I think that's great wisdom, because we do see that in investing, don't we? That it becomes one a bit tribal, or people become parochial. They think to themselves, well, this is how I've done it and this is what I know.
Yep.
But I think that's a really, really important as we kind of finish this conversation, because there's more and more coming. And that's people should be aware and open to it, I think. And I think this is a glorious time to be investing in ETFs and to be building proper portfolios that are resilient, that can take away some of the guesswork and some of the uncertainty that people have, whether it's retirement or accumulation phase, whatever the case may be.
I'm very privileged and lucky to have been part of this industry and the growth of this industry, and from when I started, really in the ETF space, because I can talk to many friends. I see it across, from young people, male and female, to older investors. They're getting into investing because of ETFs. And I think that's awesome. I think that's absolutely great. And so our job as an issuer, my job as someone in this industry, is to just help people along that journey. And so bringing out good products that I believe in, but also keeping on. And, our market is only growing. And so, to your point, more and more products are coming out there. Just do the research.
Yeah, like it. Well, Kanish, as always, thanks for joining me.
No, thank you for having me.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.